What is going on, investors? It is Sunday Q&A day here on the Investor Channel. This is episode number 4. In the description and the comments down below, I'll put a link to all the timestamps of the questions if you want to hop around this video. I'll also include a playlist with all the other question and answer series that we've done. So if you want to go back and look at the previous episodes, you can do that as well. And finally, if you have a question that you'd like for me to answer here on the channel, leave me a question down below. I'll get to it as quickly as I possibly can. First question comes from CR. Thanks for the video. I have a question. I'm an individual stock picker, but I'm constantly underperforming the QQQ ETF, which is like the NASDAQ. Sometimes I think I should just set up an auto invest reoccurring every month into QQQ and not put all this time and energy into researching individual stocks. Do you have any thoughts on this? I think this is a great question, and I actually think that you've thought this out pretty well, and I'm going to help you a little bit here with some of your thought process. Now, first of all, I'm not doing this to flex. I'm not doing this to brag. I'm just showing you that I do have experience in this sense here. I could stretch this back. I'm at 2 years. Unfortunately, my IRA has kind of bounced around between a couple different providers. I've had this IRA for many, many years, probably about 10 years now. Unfortunately, I don't get to come all the way back to when it started because, like I said, it got bought out by E-Trade. But you see for the last 2 years where we have a full data here, is I'm up 70% in this account, and the NASDAQ or the QQQ is up about 63%. S&P's up about 30%. Dow Jones is up about 15%. Now, not saying that this is what's going to happen going forward, but just over the last several years or for the last foreseeable past distance, I have outperformed most of the major averages, and I'll tell you exactly how I do it. Typically, I am purchasing very, very few times during the year. In fact, when I look at a chart of the NASDAQ, this goes by, or QQQ in this sense, we're going back to about 2013. I can zoom this in a little tighter here because I remember just looking at this chart, the few times that I've bought stocks just over the last few years. Now, the few times that I bought stock was right here in 2018. We had the tariffs. It was, oh no, all these tariffs are going to just crush the market and crush everything. Well, I knew that was probably a little overblown. There was probably more stuff going on in terms of the macro environment, but here is where I bought some stock down in here. Now, it took a while for that performance to come in, but that was obviously, looking back in hindsight, was a decent time to buy some stocks. The other time I waited, I didn't buy a whole lot during 2019. There wasn't a lot of buying opportunities. Maybe for some individual stocks, you had some pullbacks. We'll talk about that here in a minute. But just broadly, I started buying more stocks in this March and April timeframe, when obviously everybody watching this knows what happened in March here in the United States. The virus came to shore and stocks sold off really rapidly. Now, either of these times, did I catch it near the bottom of these candles? Absolutely not. I'm inching in as the markets are selling off, and I think it might potentially be overdone. I'm inching in. I'm buying some names that I want to buy, by adding to some names that I already have. Now, finally, I did buy a few, like Apple, and maybe one other share of some companies up here on these pullback candles. I think I added to maybe Visa up here as well. Not exactly sure off the top of my head, but I wait for these pullbacks. Now, that obviously is going to maybe materialize, maybe not. Maybe this market pulls back. There are definitely some areas, if the QQQ were to pull back, I would want to step in and buy. Now, here's what I would probably recommend, or here's what I would do if I was in your situation. Let's just assume you're saving $100 a month. Maybe it's more, maybe it's less, but $100 is an easy amount to kind of visualize. So you're saving $100 a month. What I would probably do is go ahead and I think you've answered your question here. I would go ahead and do that. I would auto invest into the QQQ or an S&P or a mix, maybe a little bit of QQQ, a little bit of S&P, maybe some other ETFs or other sectors that you like. Go ahead and set up an auto invest. What I would do is maybe start with about 80%. So $80 out of your 100, you're automatically investing into the QQQ, into whatever ETF, whatever reoccurring investment that you want to do. And then you're saving about $20 a month. Now, I don't necessarily want you to invest that $20 all at once. What I want you to do is use that as a strategic point to buy. And so that's really how I have gotten this fantastic performance in my IRA account. As you see here, contributions for 2020, I'm at $4,700 because we're in the 47th week of this year, or right around there. I do $100 a week into this account because that's about what you're allowed. And then towards the end of I think you're allowed about $6,000. Towards the end of the year, I'll top this off with the extra $700 or $800 that I haven't contributed on my weekly basis. So I have to be really judicious with my purchases here. Oftentimes I have a fair amount of cash. Right now I have $400 just sitting there just in cash. It's probably a waste. What I tend to do is move this into some kind of bond fund or some kind of treasury fund that earns maybe 1%, 2%, 3% yield. I could probably push it a little higher than that, but I like to keep this cash very liquid and waiting in the sidelines. So I have probably another $2,000 or $3,000 that I have just sitting there earning nominal interest rate. This earns a nominal interest rate as well. Probably could do a better job managing that. But in your case, or in the case that I'm giving you an example of, is if you have $100, leave $20 a month on the side. And then when you get these big pullbacks, doesn't necessarily have to be a big broad market pullback. We can take a look at some of these stocks. I remember one of the stocks that I probably got the best deal on was this Nvidia. So Nvidia, this was back in 2018, late 2018. It had this big red candle. These 3 big red candles. Nvidia just sold off rapidly. I bought Nvidia somewhere in here. I think it's the 160 range. Again, I didn't get it at the bottom of any of these candles. I bought it somewhere in here, and then you can see this stock as just rocketed to the upside. Amazon is another one that I've bought regularly on the dips. I did buy it earlier this year. We had this dip back in March, and if you zoom this chart back, in fact, let's change this to a monthly view so we get a little bit better view of Amazon. We had a dip here as well. This was, again, back in that 2018, late 2018, when CNBC was leading off every show with, the tariffs and the trade war and all this other stuff. And obviously all that stuff was just completely overblown. And so I came in here and stepped in. I probably added the most of my Amazon shares back up in here. And then finally we can look at a stock like Apple as well. I'm sure we can find ways and times when Apple has had these pullbacks. Again, 2018, we had that, tariffs scaring the market pullback. We also had the March pullback as well. And you've had some pullbacks up at the top end of the range. Not necessarily the best time to buy Apple, but you could step in here. Now, the other way you can do this is obviously just consistently investing into Apple, and you probably would have done relatively well. You probably would have been outperforming most indices, but I tend to like to buy these because I'm following the market. It's something I wake up, I check my phone. Throughout the day, I'm checking the phone. Occasionally, when my kids aren't watching Blippi or, Daniel Tiger, I might be able to watch some CNBC or something like that, or maybe listen to it on the radio. But if you follow the market enough, you'll know when big time companies pull back. And then you also have these broader events, like we had the virus here, and then we had the trade war here. Those are just in the last 2 years. You can probably go back and pick further levels there. So that's what I personally would do. I would go ahead and auto invest a portion of your monthly, or maybe you do it quarterly, or you do it bi-monthly, or however you consistently invest in an account, which is something I strongly recommend. I would keep a portion it on the side. And then that's how you're going to learn, okay? You're going to take that $20 and maybe you let it roll for 3-4 months, and you've got maybe $80 to $100, and then finally a stock pulls back and you're able to pounce on it with that money. That's how I would do it. And then after maybe a year, 2 years, 3 years, you can start comparing. Maybe you've gotten better at picking stocks and buying them when they're on the decline, and maybe you can allocate less to the automatic kind of recurring investment and then set more aside into your maybe your active kind of investing portfolio. That's personally how I would look at this. That's personally how I do it. I don't do any automatic investing. I just do automatic deposits, and eventually the markets pull back or there's some bad news, and that's how you want to do it. The last thing I will say, CR, and to all of you guys listening right now, it is natural human instinct to want to buy when things are good and sell when things are bad. You have to go against natural human instinct to buy when things are in the crapper, when CNBC is telling you, oh, big market sell-off, or whatever it is, or back here in March that things were just going to go, everything was going to fall apart. The whole economy, the whole world's economy, everything was just going to fall apart. It is very, very difficult to step in there and buy. But if you can train yourself to do that, that is how you're going to get these way above market average returns. I mean, S&P 500 for the last 2 years up 30%. And when you got a portfolio up 70%, that means you're absolutely doing things in a systematic way. And that's how I tend to focus on this. And the other thing to realize is you are buying stocks very, very few times per year. I buy stocks, you can probably count on one hand the amount of days I actually buy stocks. So 4, 5, 6 days out of the year, I might be buying stocks, but it's an industry that I follow the entire year. So that's not an easy thing also for investors to understand or discipline themselves or condition themselves into doing. But those are the ways I do it, and hopefully it helps you out. Next question coming in saying, thank you for answering the ETF question. What's your take on Michael Burry's prediction regarding the collapse of index funds? I actually had this on our last Q&A. For some reason, I edited it out, so I'm going to answer it today. Now, first of all, if you're not familiar with Michael Burry, he was kind of immortalized in this book by Michael Lewis called The Big Short. I highly recommend this book, even though it's been 10 years or so since it's been published. It's on the financial crisis. It's a super easy read. Like, you could literally read this in just a couple days. And quite frankly, I'm not a big reader, but I love this book. And you may have seen the movie or maybe not. I personally, like most movies, read the book first and go ahead and check out the movie. It'll make a lot more sense. But Michael Burry is immortalized in this book. Also, if you want another book that maybe you haven't read, is this Flash Boys book by Michael Lewis. Also another little, not as easy to read as The Big Short, but this is a really good book too. And I can see here, $13. You can get it on audiobook, however you want to consume these. Again, I'm not going to put any affiliate links or anything down below. I have read these books and I recommend them. Now, again, Michael Burry immortalized in this Big Short book. He had a Big Short position and he was actually a medical doctor. I believe he was practicing or he was studying to be a doctor. And he just took up an interest in the stock market and really found like a lot of faults in the way the credit default swaps were being traded. They were basically getting rated as AAA when he knew that they were going to go bust. He made a ton of money. Now he kind of runs a Scion Capital, which is a hedge fund that he's a part of. Now he sees a bubble in passive investing, which actually kind of relates to our previous question and why I don't take a passive approach. With some sectors of the market, I certainly do. With healthcare, I take a passive approach to investing in healthcare. With the oil and gas, not so much, but there are certain sectors, sometimes gold and silver as well. I'll take a little bit of a passive investing approach, investing in more broad market ETFs, but typically I'm active in my investing and not necessarily because someone like Michael Burry sees a bubble in passive investing, but it is certainly something that could materialize because so much money is wrapped up into passive investing. If you're not sure what that is or familiar with that is, that's basically like just dumping your money into an ETF that just tracks an index, that just tracks some kind of benchmark performance and just automatically just kind of invest. And it's a great way to get market returns. If you want above average returns or way above market average returns, in my opinion, you have to actively invest at least a portion of your money, not 100% of it, but at least a portion of it. And the reason why you can get a bubble in these passive investing things is, look, one or two stocks in some of these things could fall apart. That could create a bubble. Also, you have massive inflows into this. If for whatever reason you had massive outflows, it would create a cascading effect across a ton of asset classes where money managers and these funds would be forced to sell stocks that are widely held, like an Apple, like a Microsoft, like Amazon. And all of a sudden you could see a cascading effect. And if you're not in there actively actively kind of managing that or actively kind of maybe reallocating your money, well, all of a sudden you could lose a ton of your position. So, look, who am I to argue with this guy? I mean, he predicted not necessarily predicted, but he really capitalized on the last financial crisis. And if he sees something like this inside the passive investing kind of ETF mutual fund space, then I'm not going to argue with him. I think the way you can counter it as an investor is just always actively know what's going on in your portfolio. If you want to also set stop losses and trailing stop losses, if that's something that you're really, especially if you really might need this money or you really want this money or the money is, especially if you're on margin and things like that, then you're definitely going to want to pick some levels where if stocks or the entire market or single stocks really start cascading downward, well, you get out of them so you don't just see this big time drop. Now, we haven't seen those big time drops. This is a monthly chart. We have seen, the last big drop, this one went from 57 down to about 35 in 1, 2, 3, 4, 5 months. So that's a big decline in just a couple of months. So these types of drops can happen. But typically what happens is those do create buying opportunities. But if all your capital is tied up in these stocks and you let them run all the way into the ground and you don't have any money to come in here and buy down at the bottoms and buy the dips, well, then your results and your returns probably not as good. But, this is just something to definitely be aware of. And again, my advice always here on the channel is be actively investing in the sectors Maybe you're in Texas and you know all about oil and gas. Maybe you're out here in Silicon Valley and you know all about the tech stocks. Maybe you're up in Seattle and you know about Microsoft and Amazon or whatever sector. Maybe you work in telecommunications. Maybe you work in the hotel industry. Maybe you work in the casino industry. Whatever it is, go ahead and actively invest in the things that you know about, the things that you've researched well, and the things that you have fun researching. And then, in my opinion, passively invest in the things that might be a weakness for you. For me, it's medical stocks, healthcare stocks. For you, it might be something completely different. So that's how I would handle that one. Thanks for the question. Hopefully I helped answer that one for you. Next question's coming in from Dimitri. He says, hi, thank you for all your work. Really like the analysis of company financial. Thank you. It looks like Airbnb is going to have an IPO soon. That is correct. Do you have any experience investing in companies pre-IPO? Maybe do you have recommendations on the platforms which provide this opportunity and possible pitfalls? Thank you. Well, this is a good question. I don't have a lot of experience in pre-IPO companies. I'll tell you why. I did have one opportunity to get at the IPO price. That was with lending clubs several years ago. They gave an opportunity to existing account holders in lending club the chance to buy at the strike price or the initial public offering price, which I think at the time was $15 per share, which is way over, I think, where it is right now. But it went from 15, I think, up to 30, maybe even $40 after the IPO. I was able to make quite a bit of money in a very short period of time. Again, that was a very, very rare opportunity that lending club allowed its current kind of or early members, early adopters of the platform. Now, from my understanding, is to get in on IPOs, you need a fantastic relationship with one of the underwriting banks. So typically like a Morgan Stanley or a Goldman Sachs. And typically to have a great relationship with them, you need lots of money. And I personally don't have quite an account that size. And in my opinion, you're going to have to be an extraordinarily large account with those people to get that type of access. There certainly is probably other ways to get in. There might be like kind of third parties that kind of are intermediary between you and Goldman Sachs or any of the underwriters that underwrite these IPOs. It could be that there are companies and funds out there that allow you to get access to it. It's just not a strategy, in my opinion, that is for me personally. Now, other people out there might be able to find this strategy works out well for them. The strategy for me with IPO stocks is let's take a look at we'll actually take a look at RKT. This is Rocket Mortgage. These companies often come public and they sell off pretty quickly. So when we take a look at Rocket Mortgage, this is a company that we'll cover here in a minute. I have another question related to them. Well, they came public right around here, and the stock almost all the time, these things shoot up and then they sell off. Here's another one that I know of. Smile Direct Club was another one. Again, this is a stock that has just sold off. You've had an original IPO price way up here into the $20 range, and they sell off, and eventually they flatten out and they turn into decent investments. The other one that was really big was Uber. So you can take a look at Uber. Now, Uber's recovered nicely, but for a while there, Uber was pretty much of a disaster. It IPO'd somewhere in here. This may not be the exact IPO price, but this stock traded way down, all the way down into the $15. Now it's all the way back up at 50. So in my opinion, what I would do is if you can't get in early on these IPOs, maybe there's a way to do it. Maybe there's not. I think for the average investor, the investor with tens of thousands of dollars, from my experience and the people that I know, you need tens of millions of dollars to really get in on these early IPOs. Personally, what I would do is just get them on your radar, get Airbnb, start doing research on it, see what happens with the stock. They often just slide. These IPO companies just want to come down. Here's another one, Big Commerce. This one, it came out here, big spike, spiky euphoria, but then it's just come down. Again, spike back up, but then just comes right back down close to the IPO price. Typically where the stock gets offered is where the big professional money managers kind of pin the stock. And what happens is these stocks more than often get bid up by retail investors. And these are not, I don't want to say the not sophisticated, but maybe less sophisticated than the Goldman Sachs, the Morgan Stanley kind of guys. And then the stock trades off and it sells off, and more shares get released. There's always secondary offerings. There's always lockup periods that expire. So that's where executives and higher ups in the company, they are not allowed to sell in the early days of the IPO, but typically after a few months or maybe a year or so, they're allowed to sell their shares. That creates downward pressure on the stock as well, since they more deservingly deserve to kind of cash out and put some cash in their pocket based on what they've built. So what I would do with these, if you can't get in on the pre-IPO process, well, look, I would just monitor the stocks, and I gave you a ton of examples where these things pull back either at the IPO price or more often than not below it, and that's when you can kind of jump in, when you can get a better analysis of the company's financials, how many shares are going to be outstanding, what the market kind of feels about the opportunity. That's how I personally would play these ones. Hopefully that helped you. Next question's coming in from Joseph. Says, hey, Mr. Investor Channel, I bought a couple shares of STAG today at $30.15. Nice. I was looking on their website and saw that they have investor presentations, and they have a great PowerPoint presentation that covers a ton of information. I skimmed through it, and the parts that I understood, I loved. I was just wondering if you could make a video going through this document, or maybe cover it in a future Q&A video. As always, thanks for the videos. You're the best. Thanks, Joseph. Okay, so STAG Industries, here they are. It's like a REIT, and I'll talk about what they specialize in here in a second. They got about 4.8% dividend yield. The 52-week range, this thing has been down, like a lot of these REITs, down at $17, but it's really picked up nicely. It's been as high as $34 in the last year or so. And so if you're not familiar, most companies, I want to say most companies, but most of the companies that seek investment do investor presentations every once in a while. And I can imagine these have been curtailed a little bit because typically these companies' executives take these to investor conferences that have big banks or big investors in the crowd. They're trying to basically sell them on investing in the company. And so that's what these investor presentations are for. But you, the shareholder, can use these. Say you didn't know, like for me, I didn't know I've heard of STAG, but I didn't know a whole lot about them. And so these investor presentations are often a decent place to start. And so I pulled it up here. They are an owner and operator of industrial real estate. So if you're into not necessarily, so like realty Realty Income, they do stuff like with CVS and maybe more retail shops. Well, this is industrial. So companies like Amazon and fulfillment centers tend to focus on there. So if you want to get exposure to that real estate and not like residential real estate or commercial real estate, well, this is an interesting option. And so they show you here, their IPO looked like it was back in 2011. They're just showing you the growth here. They've gone from 14.2 million in square feet up to close to 100 million. And so they're just showing you all this stuff. This is really good stuff if you're in the business of picking stocks or trying to find out more about them. Again, stocks like Apple and Amazon are easy to find coverage on, whereas STAG, maybe not, okay? And so you kind of have to come here and dissect it for yourself. Really good stuff here. They show you a little, this was actually kind of an interesting slide, probably not the most interesting one to go through here on the channel, but they give you some notes based on what happened with the virus this year. So they're showing you kind of what they were historically wanting to do and then how things changed this year. And so I actually kind of like that, how they show that. They show that they're optimizing cash flow. They give you the kind of the high level points here. There's some more stuff here. This is kind of interesting. So they're showing you actual examples of what they did. So this was kind of an uncertain tenant here. They acquired the building in May 2011, and I think they negotiated with a new tenant, I think an investment grade e-commerce tenant, that's probably Amazon, and they got them in the building. Then this building was vacant, and so they talk about what they did. So it's kind of giving you like real world examples of what they did. I like this slide. This is very interesting. It's just showing you, okay, we got this was vacant. We got this, it was at a below market lease. How do we renegotiate that? Here was an expansion and extension. Here's was another below market lease. So it's showing you, and this was vacant right here. So it's just showing you how they're acquiring these, create value, like they say here, through leasing and redevelopment. So I like that. So more, here's another very specific example here. I like that. I like how they're going through this. And here's where they're talking about demonstration of portfolio premium. So they cut it off in 2018, but they kind of give you a little bit of an example here. Here's another thing where they're showing you just, they're focusing a lot on e-commerce, okay? And so they're showing you retail inventory to sales ratio and how that just plummeted this year, and then just how e-commerce has just continued to trend up. I don't think that's to anybody's surprise. And they're showing you here, 43% of their portfolio actually hammers e-commerce activity. So that is solid as well. More kind of general slides here. I'm going to zoom through a couple of these. This one was interesting to me. Here's 2019 acquisition activity. Not necessarily anything to do with the stock or STAG, but I just found this fascinating. So they had 1,250 transactions pass through the initial stage of considerations. 1,250 deals. Okay, there's 365 days in a year. So that is like I guess that's about 4 or 5 deals per day they're looking at that and then that's just what passes the initial stage of investment consideration. So they're looking at a ton of stuff. Then they underwrote 300, about 295. They closed on 61, so about 1 per week, a little over that, and 5% of transactions were acquired. Just shows you like their funnel here. They're working pretty hard behind the scenes, actually, to have the manpower to go through this many transactions and initial kind of investment consideration actually takes a considerable amount of manpower. And then as you move through these to close on 5% of them actually takes a lot of, a lot of work, quite frankly. So they show you here, top 10 tenants. This is something that you always want to kind of keep in mind here. You got Amazon, General Service Administration, XPO. That's actually one of my best performing stocks of all time. I bought this stock at 32 cents. And it's been a lot higher than that. Actually, the house I'm living in is a lot thanks to XPO. Not to go off on a tangent there. Solo Cup. These are just your breadwinning type companies in here. Ford Motor, American Tire, These companies are Packaging Corp of America. They are just going to need space, especially someone like Amazon, XPO as well, Solo Cup. They're just going to need space, and their business is not really impacted by what we've seen here in the last few years with the virus. Onto the balance sheet, I think you can get a better view of this if you pull up a 10Q or the most recent financials. I won't really look at that. They talk about their valuation here. Again, this is from the horse's mouth, so you need to do your own research on this and do your own comparison on this. They're showing you peer average at 30x multiple on the FFO, funds from operations. They're at 17, or at least when this slide was created. They give you a little of feel-good stuff, environmental, how they've won some awards here, more social responsibility. Not exactly sure if it's important, but not necessarily from a shareholder perspective. Philadelphia, they're showing you their markets here. I like this too. Okay, about 8.7% of their market is Philadelphia. When it's that concentrated, you definitely want to pay attention to that market. And if you're out there in Philadelphia or close to there, you know that market well, certainly could be an advantage for you as well. Again, here's a little bit more. They show you their tenant activity in recent years in Philadelphia, and then they show you Chicago, which is 7%. So just, about 8 call that 9, call about 16% is between Chicago and Philadelphia. So both those markets are critical for this company. And so that's just something you want to keep in mind. And then finally, Greenville, another city I actually have ties to. My dad was actually born there and actually did pretty well in real estate in Greenville. And they're 5.8, close to 6% of their market. I know that BMW, I think this is the BMW plant. They just invested huge amounts of money, $10 billion since 1994. So you can imagine if you owned some land in Greenville in the 80s and 90s, you probably did pretty well since BMW has moved to town. And so they've done incredibly well. It's a forward-thinking city out there in South Carolina, and they've helped BMW develop this plant, and it has spurred the local economy. Here it is down in here, if you're not exactly sure where that is. And that's the slide for you. So with this question, I think you got it at 30.15. That's about where the stock is right now. This is one, with these REITs, I'm not in here trying to trade these things. These are kind of buy and hold things. You're getting a 4.8% dividend yield. It's one, if it pulls it back a little bit more, sure, you could probably step in there and add. It's in in my opinion, a relatively safe sector in terms of e-commerce, fulfillment, industrial kind of things. You see here, they are raising capital, so they offered 8 million shares. And then up to another 1.2 million shares. That is typical. It's not necessarily something that is uncommon, and it allows them to expand their operations. And so this is actually not a bad time to come in here and buy these when they dip on this news. Sometimes I come in there and add a share or two, or whatever percentage you're trying to add when they add these shares, because it tends to make the stock go down. So hopefully I helped you out with that one. And for everybody else watching, when you want to invest in a new company, and it's not like an Apple or an Amazon or one of these companies that are just covered to death, well, the investor presentations are a good place to start, and it can lead you down a rabbit hole of looking into their financials and other documents as well. Hopefully I helped you out with that one. Next question coming in from Yan Wu. Hopefully I said that right. Great video. Have learned a lot. Could you comment on RKT, which is Rocket Mortgage? Thank you. This is a company that I've swung trade. I've covered in our swing trade. I've also done an individual video on this one. I didn't cover it on the last earnings report just because things are about stable with this one. Now, Rocket Mortgage is one of the leading mortgage providers here in the United States. It is founded and kind of think still operate a little bit by Dan Gilbert, the owner, one of the owners of the Cleveland Cavaliers. Now, Rocket Mortgage, when I looked into this one, specialized primarily in refinance. Okay. They weren't as big as in origination. So if you're a new homeowner, if I'm going to go out and go buy a home, I will need a mortgage originated for me because I am, buying a new home. Whereas Rocket Mortgage, really their bread and butter was the refinance. And as we saw rates just trickle down and down and down, well, they took up a lot of business because their refi market is big. And so Rocket Mortgage, for them to continue to grow, or their growth avenue is in that mortgage origination market, not necessarily in the refi. They've already kind of dominated that, and I haven't seen any stats on that, but I bet a lot of people refied, and I would guess that next year that we probably won't see as much refi. I mean, there's still going to be a lot of refi, but we might not see as much. Now, the refi market is tied very closely to home values, because if home value is going down, it's a little harder to refi. Whereas when values go up, you can cash out, refinance, and those type of things. But if the market starts to go down, you see prices down, maybe that spurs new growth in the origination market, because I know a lot of people that are trying to buy a house, but it's hard to buy one. There's not a lot of supply right now in terms of the origination side and on the market, and just prices are really high, especially out here in California. My view is a little skewed. Where you're at might be a little bit different, but Rocket Mortgage, in my opinion, from the broader mortgage and kind of real estate market, would benefit from a more competitive market where we saw more supply and, about the same amount of buyers. We'll see if that materializes next year. Just all the stats I've seen on the real estate market is that just supply, the availability of homes for sale is just still really, really low right now. And when that turns around, I don't know. It's anybody's guess. Now, a little more certain actually here on the stock chart. I'm glad you actually brought this one up, because now this is on my radar as something I might be trading here pretty soon, because you see here, I've got two nice distinct channels. Obviously, this is a recent IPO company. Then I've got a lot of data here, but we've got these nice channels that have formed. Now, this upper end of this channel, right, we'll call that $24, is pretty firm. Okay, this when the stock gets to 24, it has kind of hit its head here, and has gotten rejected. But we've seen some support down here at 19. We did slip below it here back in October, late October, earlier this month in November, and it got down to 17.80. So be a little concerned as we kind of walk our way down to the $20, right at $20 even for this one. Probably wouldn't jump all the way in with this one, but this would be an interesting swing trade in my opinion. You walk this stock back into the low 20s or $20 exactly, and I think you could start a position here. You could be safe and set a stop loss maybe under 18.25 or even lower if you really want to be safe, or be less aggressive, or less safe is a better way to say it, 17.80, because if it breaks this all-time low, who knows where this one is going. But this should create a little bit of area of support here, but also this $20 level has provided some support, and the stock has bounced. It bounced here, came down here, and bounced back up into the mid 20s. So that's how I personally would play this. I would buy it at the 20, hoping for a 10% gain in a few days, weeks, or months. That's how I personally would play that chart. From a fundamental perspective, everything looks fine to me. Again, you're really tied to the refi market, which I think is cooled a little bit, and the origination market is pretty chilly out there too, because there's just not a lot of supply. I just see this as a stock that's probably going to be range bound for a period of time. And in my opinion, that's a good time. If you believe in it in the long term, 5, 6, 7, 10 years down the line, well, look, that's a great time to accumulate the stock when it's kind of range bound and not doing these big up and down kind of swings. The other thing you can do is kind of swing trade this one. It looks like it's setting up nicely, a nice little wave. So we'll see if that materializes. Hopefully I helped you out with that one. Next question's coming in from a Zed. It said, thank you for your channel. I'm new to the stock market and already learned a lot. Well, I appreciate that. Can you give me a review on the REIT Innovative Industrial Properties, ticker symbol IIPR, and if it is a long-term investment opportunity, in my opinion? So let's take a look at this one. It hasn't been around that long. It looked like IPO at the tail end of 2016, and it's just been on a rocket kind of since then. They've got a dividend yield here about 3%, which is nice, not necessarily super hefty, although the stock has made a monster move. When we take a look at the chart, the stock has made a monster move, which has probably pulled back the yield just slightly. Now, I will just give you an idea from a chart perspective, also from a funds from operations, or FFO, taking a look at what we see here with this stock. And we see here, for the 3 months ended, this thing is in explosive growth mode, okay? Because we went from 1 billion up to, 6.1 million up to 18 million here. That is some really fantastic growth just on the net income side. So that is a really fast growth here. And so what it tells me is this company is probably likely acquiring properties, adding to its portfolio, and it's really firing on all cylinders. This is fantastic for a REIT in this environment. It just shows me that they must have some really secure tenants, and they must be collecting the vast majority of the rent, because this is fantastic on the net income side. They're also controlling costs nicely as well. We see a little bit of depreciation here as well. And then we've got FFO attributable to the common shareholder is at 26 million. That compares way over 8.4 million in the previous. For the 9 months, we went from 17.6 up to basically 63. So just, this is like growth you don't normally see in a REIT. But again, the stock chart just shows you here too, as these REITs really grow like this, it's going to bring investors in. And so we see here, FFO per share, we've got $1.23. Well, let's look at it from a diluted basis. $1.22. It was 76 in the previous period. We went from 172 up to 340. We see here they pay a $4.68 dividend. So it's right there. Okay. So they're it's a strong payout. They have it well covered. If they continue this type of growth, you should see an increasement of that dividend as we move forward. We also see you're getting diluted on these shares too. We had 11 million shares. Now we're up to 21. But again, this is what's financing this growth. It's always a double-edged sword with the dilution. Okay, if it's a well-run company, I don't typically mind it. When it's one of these speculative stocks that don't have a product or a lot of profit, well, then it's not always the best thing, doesn't always work out. But in this case, it looks like it is. So everything looking great here, man. This company is doing really nice things from the financial perspective. It looks like they're controlling costs to me as well, and all things are looking really good there. From a stock chart perspective, this thing, it looked like it kind of made this like cup handle formation and just boomed. This is a monthly chart to kind of, what I wanted to do is bring back these all-time highs. We made these all-time highs back in 2019. The stock slid off considerably this year, all the way down to the $40 range, found support down here, and then has just been on a rocket. It actually went all the way up to about 165. It's pulled back a little bit. Now we're at about 150. This one for me, just if you're watching this and you want to maybe add this one, do a little research and think you might want to go long this one, well, any pullback in this range, 125, should provide a pretty serious level of support, in my opinion, because this was our all-time highs here. And we also see for 3 months, it kind of acted as resistance here. And then when we shot through it, it was like, hot gas shooting from a rocket, and we just shot up to the sky. So as we come back onto this one, the tops of these candles, these wicks here, probably will be, the first kind of realistic stopping point back in the 130s, 140s. But, really, if you want to play this one all the way back, if for some reason we have a pullback in this or the broader markets, 125 would be a really interesting level for me. Look, this one's looking really good to me. Okay, I would allocate everything properly. Okay, I wouldn't necessarily be completely overweight this REIT, but certainly your allocation into this one, as long as it's consistent with the rules that you have set up. I like this. It looks great. It's a great performer. Their financials look fantastic. I took a look at the balance sheet. There was nothing wrong there. This stock chart has gotten a little accelerated. Wouldn't necessarily be excited about adding to my position up here, but any kind of pullback, like I said, to 125, and I'd be pretty excited about this one, honestly. Hopefully that helped you out. Next question coming in here said, hi, as always, thanks for the video. Really appreciate it. Thank you. Would you do an analysis on Shift, ticker symbol SFT? The idea is nice, but I'm wondering if I would buy a secondhand cars online. The figures look promising though. Okay, so Shift, when I first looked at it, the first red flag that I see is the stock's under $10, and the stock actually has fallen really quickly. I mean, when we cut over the stock chart on this one, this is just a ski slope of a downtrend. So again, that's not necessarily, I mean, it's bad if you bought up in here, okay, and you bought this at a higher price, but it does create opportunity if you do like the stock, you do like the idea. So I'll tell you what, I'm going to leave it up to you guys to figure out if the idea is any good. In my from my rules of investing, any stock under 10 $10, even $20 these days, I'm really not touching, but that doesn't mean that there's not an opportunity here. Let's jump into the numbers though. This is where I probably can provide some value to you guys listening out here. So you've got as of December 19 and into September. So this is a 9-month view here, just a straight 9-month view, because this company, it looks like it just recently IPO'd. So it hasn't had a full year of earnings, or at least they don't report them here. So we've got cash here went down big time. So we went from 42 million. So yeah, we went from 43 million down to 18 million. So boy, cash is flying out of this business. That is not good in my opinion. Now, some of it looks like it has flowed to inventory. Looks like this company might actually hold the inventory, which is risky, but could pay off. You never know. We went from 18 up to 33 in inventory. So some of this cash, when we get down to the operations, flowed out because they lose money, but also it looks like some of it flowed into inventory, because we look here, we had about 65 million in assets and now of current assets, and now we've got 62. Not necessarily the greatest thing. Total assets went from 82 down to 77. So our assets went down, and take a look at what happened to liabilities. They went from 39 up to 85. And so we've got some long-term notes, we've got some warrants, essentially debt on the balance sheet as well. And we don't have the cash to cover it, although we do have a considerable amount of inventory. In fact, about half of the total assets are actually tied up in inventory. And when we're talking about cars, not always the best thing, because they do depreciate. Almost all cars depreciate in value. Let's take a look though, from an operating perspective. We went from, this is 3 months here, 19 over 20, and then we've got the 9-month view here. We went from 36 up to 48, and that's just their e-commerce revenue. Looks like they've got some other revenue as well. It's, I wouldn't say insignificant, but it's a smaller part of their business. So we went from 45 up to 60 million in total revenue. Now, the problem is, this was a good quarter. The problem is the 9-month trend, not quite as promising. We went from 138 down to 122. Don't always like to see that with these young, kind of unprofitable pre-IPO or kind of post-IPO companies, recently IPO'd companies, probably a better way to say that. We've got cost of sales here. So we spent 56 million to make 59. So we actually turned a positive gross profit for the 3 months, and we did the same for 9 months. We spent 111 and then an unlucky number here to make 122 to make 10.6 million. Not bad. Now, unfortunately, it's not the full story, because they have some selling, general, and administrative expenses. We went from 16 up to 24. That was a big jump in this quarter, because take a look, for the 9 months, we're basically flat. We went from 54 to 52, actually down to 52. So the expenses were actually flat on a 9-month basis, but for some reason on the 3-month basis, they accelerated a little bit, actually quite a bit. And so that led to a loss from operations of 21.5 million. We were at basically 18 million the previous period, and we went from 57 down to 44. So a net loss of about 23 million. And so that's a problem, because some of that money is coming right off of the balance sheet. You can see in a 3-month period, again, if you look at cash flow, let's take a look at cash flows, because that's probably something we should do here. We've got, oh man, cash flows are really bad too. Take a look at this. We got 9 months ended here, 19 over 20. We lost 18.8 million in cash flows, but we lost 46 million in cash flows. Just a horrific quarter. Okay, this is why cash is flowing out of the balance sheet, and this is why the stock is doing what it is. And this is great. If you're watching this, this is how you understand these companies and understand maybe eventually things turn around. What investors are looking at is, we got 18 million in cash. We just had 45 million, 46 million in negative cash flows for 9 months. We just had an operating income of just 3 million. That's a paltry 3 million. But you take a look at loss from operations, 21 million. Again, some of this is baked into, it looks like they have some stock-based compensation, but it's not much. It's 7.6 million for 9 months. Divide that by 3, we'll just call it 2 million. Okay, so of this loss from operation, about 2 million of it is non-cash stock-based compensation. You're still losing about 20 million, $19, $20 million per quarter in 3 months. and that's all they have in cash. So that's a problem. So this company is going to need to do some kind of fundraising, or they better sell a crap ton of cars over the next 3 months if they don't want to have to tap some of this cash. So that is what investors are seeing, is that this company is in some level of financial distress. Again, not that they can't turn it around, but they are going to either have to sell a ton of this inventory and turn it into cash, or they're going to have to raise money through, more debt offerings, more share offerings, which again are negative for current shareholders. So what I see here is just a stock that's just on a downward slope. I would not be in any hurry to come in here and grab this one. I would wait to see where this one bottoms out, even if it turns positive for a little while and kind of creeps back up. That'd be the only time I'd want to jump in here. Also, I'd want to see this balance sheet turn around. Make sure they've got they might have to do another round of fundraising that might take further air out of the stock, although it's going to be tough. When you've got a $6 share price, it is hard to do more fundraising down there. So they might have to take on different kinds of debt, warrants, preferred shares. There's just a lot of things that they can do that's not usually good for the common shareholders. So this one, in my opinion, I'd stay away from. Again, you could put it on your watch list. We've got a $540 million market cap on this one. And again, on a company that looks a little financially distressed, in my opinion. Can they turn it around? Certainly. Is there a lot of competition in this space? Oh boy, you bet you. There is a ton of competition in this one. So it's going to be tough, in my opinion. So that's Shift Technology. Not trying to barbecue it or put it on the fillet, but I just got to give you my honest outlook on these stocks as they come in. Hopefully that helped you out. Next one coming in, nice analysis on HYLN, but you absolutely missed the update on the balance sheet. The company has raised $520 million from merging. Actually, not from merging. They raised that from shareholders. Could have more than $140 million from warrants. Again, that's not necessarily a good thing. So it makes another story regarding the balance sheet. That is true, and the cash position of the company. If you would read a few more words from the quarterly report, you would know that. I agree that it is a speculative play and they don't have a product yet, but we cannot know the execution of the management if the product is good as they expect. So look, the way I analyzed this company, I did analyze it from a post-merger perspective. And yes, when you add this $520 million that they got from shareholders and another $140 that they'll get from more shareholders, basically, yes, they'll have $660 million in cash. But again, are you investing in this company because they got money from shareholders? That's what you have to ask yourself when you're investing in these kind of pre-product, pre-revenue companies. Are you buying it because they can raise money? No, you're not. Okay, I'll answer that question for everybody watching. You're not buying these stocks because they can raise money, because they can sell shares of the stock. You're buying them because they have a product, because they can execute, because they can make profits, because they can make the stock go up. So it doesn't matter whether you analyze that they have $520 million or $0. It really doesn't matter. What you have to analyze is, can they execute on this product? Can they bring it to market? Will there be a market for it? Again, can you develop a sustainable investing system investing in these types of company? In my opinion, in my experience, absolutely not. Okay. Yes, you can get lucky with one of these companies that raise over $600 million from investors with no product, no profits, no revenue. Yes, maybe one of them hits a home run and you make a lot of money, but try to do that year after year after year for 10, 15, 20, 30 years of your life. And I almost will guarantee you that you will lose more money than you'll make. You'll hit more ground outs to first than you will hit home runs. In this business, in my opinion, it's all about hitting consistently, hitting base hits, doubles, triples, and occasionally a home run. You do that enough, you will outperform the market. And I have a portfolio and a track record of being able to do that. Not to say that this company won't be successful, but investing in companies because they can sell the shares, they can issue warrants, and they can raise money doesn't mean anything for you, the common shareholder. In fact, it creates lots of risk going forward, and I would just be aware of that. But thank you for bringing that to our attention. Next question's coming in from Harry Fung. Love your analysis. Learn a lot on the balance sheet. Love to hear about SunPower, ticker symbol SPWR. Is this stock growing? That's a good question. U.S. government might use more SunPower or renewable energy in the future. Recommendation. So first thing I'm going to do is just show you the stock chart of this one, just in case you're kind of new to the market, or, I'm not talking to necessarily Harry here in particular. He might not be new to the market, but here's just the hype and euphoria. I remember when solar stocks, you couldn't turn on CNBC for 30 minutes without hearing about a solar stock, and the air got left out of the room. So those are things you have to be careful when you invest in these companies. Now, it has made a comeback. When we jump back over to this chart, it is approaching a level where if it can get above that, there is some, sunny skies ahead for this one. We'll jump into, he asked specifically, is this company growing? And so we'll take a look at from an operating perspective here. So I guess these are, I'm going to just, I don't know. I'm assuming these are in thousands. So I don't see it here at the top, but I'm going to just read these as in thousands. If they happen to be higher than that, this company's probably doing pretty well. So we've got 3 months ended here, 19 over 29 months here. So we've got solar power systems. That's the vast majority of what they're doing. So that the others is almost inconsequential. So you'd like to see that grow, but it actually in the last 3 months, it declined a little bit. Again, could be, a little bit of virus stuff, could be a little bit of people aren't moving as much. Maybe that has to do with solar power systems being installed. Maybe building has been curtailed a little bit. That could have an impact as well. Also, we're seeing a curtailing, at least of the solar credits. I believe they go down next year and they totally get eliminated the following year. If that isn't, renewed or impacted, that will probably impact these guys' revenue. But we see for the 9 months, we went from 690 up to 783. So while we went from 286 down to 274, the 9 month, yes, we are growing on our top line. Now let's see about our bottom line too. So we've got solar power, our cost, we spent $233, pretty low margin, really low margin business. Spent $233 to make $267. We spent $236 to make $277. The margins really aren't expanding, and how competitive this is. I'm about to get solar installed. It was supposed to be installed last week. I think it's probably in a week or two in my house. So I have some experience researching this. It is a very, very competitive, and the margins have just been squeezed out of this because it's competitive and it's just not a very high margin business. You see here, we spent $237 to make $274. We spent $240 to make $286. For the 9 months, we spent $691 to make $783. That's not a bad gross profit. Look, this isn't bad. Okay, we made $37 million. That it compares unfavorably to 45, but for the 9 months, we went up from 77 to call it 92. Now we do have other expenses, unfortunately, especially from the selling general administrative side. It's you probably get a fair amount of leads, but to close those leads into paying customers, probably a little difficult, but not bad here from the operating perspective from this. So now they did have this big gain or loss from impaired residential lease asset. That kind of skews these numbers quarter over quarter. So I'm going to look more from the 9 month, even though, we're getting kind of skewed here. Gain on business debenture here. So their financials are skewed a little bit here from the operating income side. From some of this gain and loss on impairment, we also had a business debenture. So there's a little bit of this skewing this operating income, because we see we went from negative 20 down to 2 million negative. We went from 29 positive to 29 negative. That's really, really bad. So what I would really more focus on is actually gross profit before all these other things come out. And so we see here, we made 37, but we spent over 40 million. So we lost money without this other stuff in here. Same thing here. We spent, this is about 49, call it 50, and we made 45. We spent here, this is 220, 30 million. Wow, we spent a lot of 130 million, about 100, a little over 130 to make 90. Here we spent, that's about 156 to make 77. So we're just losing money here before any of these other kind of special kind of one-time either benefits or charges. So that is not a good thing, okay? And then obviously from a net income perspective, it's not going to look any better. Now, from a balance sheet perspective, when we flow up here, things are not that bad. They have a fair amount of cash here on the balance sheet. They do have some debt here, actually quite a bit of debt. They've got this convertible portion here. They've got some short-term debt. They've got longer term debt down here. Boy, this company is heavily leveraged on their balance sheet. And for a low margin business, it's going to be tricky to kind of turn this around. Okay. If you're in a high margin business and you've leveraged this balance sheet out quite a bit, well, then it's a little bit different story. But when you're on a low margin business and you're still losing money, to really turn this around, in my opinion, it's going to be difficult. Now, your question did say, will the government or things like that use more sun power? Maybe, maybe not. I don't know. The way government works is, yes, it appears at the moment you have a Democrat president and you have a Democrat controlled by a very small majority in the House of Representatives. And it appears, although this is not for certain, it appears that you will probably likely have a Republican controlled Senate. So it is not, no one is going to get anything done for the next 2 years. And I'm kind of generalizing there a little bit in terms of the federal government side, but you're likely not going to see a lot of movement. Now, I know out here in California, every new building has to have solar power, and how that helps the housing crisis, especially affordable housing, I don't know, but I don't want to get on a sideways rant on that topic. But okay, moving over to the stock chart, maybe things are actually pretty good here. We're in a very sustainable uptrend here on this stock. It's been bid up, but it's coming into a level of resistance that has been firm. It was firm back here in 2009. It was firm back here in 2014. And here we are again. So if this stock comes to this level, believe me, there's going to be lots of technical guys that are going to be watching this. Some from the short end, they'll step in here and start shorting this stock as it approaches this level. If it peaks its head above this and you start getting more and more rallies above this, especially above, I have this marked out at 25, but I would say above 28, 29, boy, there's some green sky. This thing could get to 35. It could get to 43. So from a trading perspective, could be some opportunity here, but you're going to have a lot of guys step in on the short side I'm sure they're already kind of stepping in here. You've got, oh my goodness, look at the short interest, 47%. So I can imagine that is actually ticked up. That might has contributed to some of this rise, is you've had a little bit of a short squeeze, but then the guys with balls of steel are like, no. We've read this balance sheet. It's a low margin business. They're heavily leveraged. Yes, they have some cash, but they are not making any money, and they're probably not going to make any money in the near to short-term future. And so this one's likely to slide down. That's how I read this one. Again, the secular trend, the broader trend might be good, but I would never, ever rely on the United States government as a factor in my investment, because the government, especially if it's split, but every 2 years, you basically can split the government or change it one way or another. Who the president is almost irrelevant. It's not 100% irrelevant, but it's widely irrelevant in my opinion. It's the split between the House and the Senate and how well they are working together, either as one party or two separate parties. And in my opinion, over the next 2 years, you're likely to see absolutely nothing come out of the federal government. And potentially in 2 years, typically the incumbent candidate loses even more seats. So a Democrat-controlled House could end up flipping red, and the Senate could get even more red, which would mean for a Democratic president, even less gets done. And in fact, you probably have investigations and and all kinds of committees and things like that looking into all the bad thing, quote unquote bad things that an administration may or may not be doing. So not to really put a complete downer on this one. I love just solar from a general, like I said, I'm putting it on my house. From a general perspective, I like it. From a stock perspective, these were once the darlings, like 420 stocks, 3D printing stocks, EV stocks. Okay, everybody's had their turn in the sun, and it tends to fade away, and that's what happens with this one, although we're coming up to a key level, so I'm actually going to be watching this one going forward. So hopefully I helped you out with that one. Next question coming in from Mr. White says, thank you for doing these video, much appreciated. Thank you, Mr. White, and thanks for everybody watching these. I really do appreciate it. If it wasn't for you guys, I wouldn't be able to do these. For the next episode, can you look into the pros and cons of using margin to invest in dividend stocks? For example, Interactive Brokers, IBKR's margin rate is 2.59%. If I were to take that, invest in dividend stocks yielding 3.5 or 4%, and the spread, it is over several solid dividend stocks, not risky 6 to 7% yield, would I come out ahead by pocketing the difference? Do you see anything wrong with this strategy? Thanks in advance. Now, first thing I want to say here is this is a strategy that I am absolutely aware of. Now, I personally don't implement this strategy. I don't typically have margin in any of my accounts. It's just not something that I do. I'm not saying that it's not something that you should do or anybody out there should do. If you're comfortable with it, if you have the experience, if you have a plan like Mr. White here has, I don't think it's necessarily a bad thing. I do have some friends that work at investment banks. There's some definite strategy here. Am I sophisticated enough? Am I familiar enough with the strategy to give you a lot of good tips? Absolutely not. But what I would do is actually encourage you to do some more investigation, maybe not necessarily here on YouTube. I don't know if there's anybody sophisticated enough executing these strategies that are giving you information, but there should be some written stuff out there. There might be some books here on this topic as well. But absolutely what you are illustrating here is a strategy where you borrow at one interest rate, you invest in stocks that have a dividend that protects you from this margin rate. You maybe get a little capital appreciation on top of that, and it is absolutely a strategy. The only thing that you need to maybe be aware of is these interest rates tend to be floating on that margin side, and so that's just something that you want to keep in mind, that if it goes from 2.59 up to 3.59 or 4.59 for whatever reason, then you obviously will need to adjust your strategy and maybe adjust your holdings as time goes on. So, and also what I would probably do, just, from a safety perspective, is do have some stop losses, some trailing stops, because you have a specific strategy here where you're pocketing this dividend. You wouldn't want to have massive capital depreciation. Let's just say, for example, you invest in one of the stocks and they cut the dividend or they eliminate the dividend. Well, then all of a sudden your strategy has been blown up on that stock. You will want to have stopped out of that stock, although in those cases, typically a stock will just gap down below your stop, but you'll have a little bit of protection in there just in case there was some market activity before an event like that actually took place. So those are some of the things I would think about. Is this a strategy you can implement? Absolutely. I would do as much research as you can, and definitely maybe take it slow. Let's just say, for example, Interactive Brokers gives you 100,000 at 2.59, and on Monday, I probably wouldn't have that whole 100K invested. I would inch into it. I would play around with it a little bit. I would develop a strategy, find a core group of stocks you're going to be kind of getting into, and kind of go from there. This is a great question. Hopefully that helps you out. Next question is coming in from Max. He says, does Corsair Gaming seem like a good stock to hold for the long term or short term? It may seem that once the pandemic subsides, the gaming sector may go down. And I'll be honest with you, I had no idea about this stock, but this is why I love that I have this channel now, and why I love hearing from you guys is because you guys introduced me to these stocks that I literally have never even heard of. This has a $3.7 billion market cap. I'm going to talk about the revenue, and then we're going to take a look at this chart. And let me tell you what, this chart is absolutely fantastic. So from the short term, I'll tell you what. Now, what I would say, Max, is decide what you want to do with Corsair. Now, maybe you have two different views on it, okay? Maybe you have two different portfolios. You have a short-term portfolio and you have a long-term portfolio. I would pick one, okay? I do have some stocks that I have in a short-term portfolio and a long-term. Like occasionally I'll trade Apple, but that's usually in a short-term account. But I have my long-term account where I've never sold a single share of Apple. In fact, I only look to add to it. So I would pick. So that's the one thing with your question. And it might be just the way you worded this question. I'm not here to try to pick on you. I'm just get you to think about these types of things. And anybody out there watching, make sure you come into investing in a stock with a clear plan. This is why I and a lot of investors that I know have multiple accounts. Okay. You have a long-term account. You have a short-term account. You have, maybe an account where you just do options. You have an account where you just do dividend paying stocks, whatever it might be, or just ETFs. Pick a strategy and then kind of run with it. But you can do both. I'm not saying you can't be long a stock and then play a short-term bump in this one. Okay, now what I will say is this stock is just recently IPO'd. I mean, it's just a couple months old. I mean, this thing's a baby. And so that is one thing to keep in mind. We have limited amount of information to go on. I'm not going to go into fundamentally what they do. I don't necessarily think that's my strength in this sector, but I'll show it to you from a numbers perspective. This is absolutely phenomenal. Okay, take a look at this net revenue. You can see why this stock has been just ripping higher, because you can see the 3 months ended here, 19 over 20, 9 months here, went from 284 to 457 in a year. That is absolutely just blowing it out of the water. You see our gross profit here doubled. I mean, it doubled in a year. This is what investors salivate over, and this is why this stock has just been on a monster move. Gross profit doubled. Now, again, like the question asked, when this thing subdues, is this gaming sector, this is video games, streaming, things like that, will it go down? I'll be honest with you. I got 2 little kids. I've got a PS4 that hasn't been turned on in over a year, okay? So I am not as in tune with this sector as when I was in college and a little bit younger. But from my opinion, probably not. I just think the gaming sector has a lot of tailwinds behind it, even as people are allowed to maybe go back to movie theaters, go back shopping, whatever it might be. I still think gaming is strong. Now, from a gross profit perspective on our 9 months, it doubled. Oh my gosh, I just love this. And then take a look. We've got these other expenses here: selling, general administrative, product and development. What do you normally see with a company that's this young that makes 127? Well, what do they normally do? They spend more than that on the operating side. This company didn't. They spent 78. They flowed $49 million down to the operating side in a quarter. That's phenomenal. And it was 4 times, it was like 5 times higher than the previous year. This thing is absolutely on fire. We went from 9.5 to 99 in 9 months. That is like a 10-fold increase on operating income when our gross profit doubled. So we doubled our top gross profit, but we 10-folded our operating income. That is just showing you that. Take a look at product development, just barely flat. Sales and general administrative, I wouldn't say that's flat, but it's barely up considering how much the top line is growing. Whoever is running this company is doing an absolutely phenomenal job. It's flowing down to the net income side as well. Guys, this just looks absolutely phenomenal to me. Now, from a valuation perspective, we've got a $3 billion company. We flowed $60 million to the net income side. Some of that's probably stock-based compensation. You might want to just look at it from an operating side, bolt on maybe another 40 or 50 million, and you're at 150 million. And at a $3 billion valuation, probably not as hefty. Now, again, like the question asked, you probably have to believe that this sector is going to continue. And take a look at this stock. It is just ripped. I mean, just absolutely green on the screen here. So if you wait for a pullback, that'd be my opinion. I mean, these levels down here are way more well-defined. So again, not a lot of data to go on. You might have to chop this one out to maybe like a 30-minute time frame, and maybe you can find some more levels in here. That's typically what you can do with these IPO companies, is instead of looking at it on a daily or certainly like a weekly or a monthly, you might be able to find levels here, but man, they're way lower than where we're at. We're up here at 41, no, way lower. And down here at 36 would probably be the first spot where I'd be excited, although there's another level up here. Again, these are really not very well-defined levels. So you kind of have to inch into these ones, or kind of just have to close your eyes, hold your breath, and jump in the pool with these types of ones down here at 38. But again, from a operating perspective, I'll tell you what, this one's going on my watch list. After I'm done with this video, I'm going to look into this one a little bit more. Just from an operating perspective, this is one of the best especially early stage companies that I have ever seen. This is absolutely phenomenal. I can absolutely see why this stock is ripping. It's probably very undercovered. Take a look on Seeking Alpha. It's only got 3,000 followers. This is not scientific by any means, but if you go look at Tesla or something like that, they probably have 500,000 or close to 1 million people following the stock. So nobody, I mean, by nobody, I don't mean anybody, but almost nobody is following what's going on with this story. And it is absolutely phenomenal from an operating perspective. And I definitely want to look into this. Max, thanks for bringing this one to me. I think from the short term, could come under some pressure just because it's just had such a monster move. But from a longer term perspective, if they keep up these operating results, a $3 billion valuation is not nearly high enough for a company that's growing like this, both top and bottom line. So thanks for bringing that one to me. I'm definitely going to be checking that one out here very soon. Thanks, Max. Next question's coming in here from Helen Lee. Thank you. Please keep the channel as is, for sure. No, definitely. I'm definitely loving all the support that I've gotten from you. When I started this channel, or kind of uploading more videos in the beginning of this year, I had like 1,000 subscribers. Now I think it's like 40 or 50,000. So I just want to thank all of you for enjoying it. And the more you guys enjoy it, the more I will definitely try to post as many videos as possible. Would you recommend ARK Investment ETFs? So I went to their website. Here's ARK Invest, and they've got a couple ETFs. These are actively managed, and they've got a kind of more passively or index ones. And so here, yeah, for sure. Yeah. I mean, what you got to analyze when you want to invest in an ETF. So let's take a look at this innovation ETF. So the things that you want to kind of keep in mind are the fees that they charge, but also what the allocation is. And so you can see here that the vast majority of this one in the top 10, you've got Tesla, you've got Innovate, you've got Roku, you've got Square. And so that's the only thing that I would keep in mind is when you pick one of these ETFs is, do you want to invest in these companies, or maybe you already own Tesla and Roku and Square? Do you want even more exposure to them through this? And then finally, you got to take a look at the expense ratio. This one's 0.075, which I wouldn't say is high. It's not necessarily rock bottom low, but this is a quote unquote actively managed ETF, which means you do have somebody or some buddies behind the scenes, pulling strings on what they're buying. And then finally, you take a look at since inception, up 30%, 5 years, 39%. You see just in the last 3 months, year to date, I mean, this thing has been performing. And so those are the things that I would keep in mind. Just the expense ratio. You also want to take a look at just what they are investing in. And finally, and go ahead and pull the trigger if you want to. So no, I don't see anything here that would make me be like, no, I wouldn't invest in any of these ETFs. Again, it is all your own decision, your own portfolio specific division. I would always just come into their website, see what the top 10 holdings, boy, they are tied really closely to Tesla, Roku, Square. I see that kind of repeating over some investments. So I could see why they have some just monster performance in the last year, because those stocks have been ripping. So those are just some things that you want to keep in mind. Looks like their expense ratio is right there at 0.75%. All things being considered, wouldn't be, I wouldn't definitely not recommend it at all. They look fine to me, and I have heard of them before. Not something I particularly own myself, but if I needed exposure to any of these sectors, I certainly wouldn't shy away from this company. Looks like they're doing a nice job. Next question says, out of the FAANG plus Microsoft plus Tesla stocks, if you had to choose just one to invest in, which one would you invest in and why? This is an easy one for me to answer. It is Amazon, because Amazon has their finger and their hands in so many cookie jars. It is hard to keep track of it all. Okay, so obviously e-commerce, they're the number one provider here in the United States. I don't think that's going anywhere. I also think they have lots and lots of room to grow there. Obviously with cloud computing, there's lots of competition out there with Microsoft, IBM, Google, and other companies out there, smaller companies as well. So there's competition there, but they are a big time player in cloud computing. But then they have a lot of other stuff going on. I was listening to a podcast just recently about their PillPack acquisition. They're getting into pharmacy. There's a lot of products that you just don't buy yet on Amazon, and that's certainly a market opportunity for them as well. I think shipping and logistics will become a massive part of their business. I think you're going to ship packages with Amazon instead of FedEx, UPS, or USPS. I'm not saying they're going to eliminate those companies, but they are going to take market share away from them. And finally, Amazon is in the advertising space because they have one of the world's most popular websites, or at least here in the United States. That means lots and lots of ads can be placed on their website. And I haven't seen the recent stats, but I can imagine they're very, very close. If they're not in third place right now behind Google and Facebook, they likely will be very soon. And that is a great place to be. So they're in a lot of really, really good markets. And there's lots more. There's voice AI with their Alexa technology. There's just a lot of things that Amazon in. Again, nothing against Facebook or Google, but they have one vertical that they basically make money on. Apple, similar story. They've gotten a little more diversified. Netflix, completely one-dimensional. Microsoft had a little bit broader. Tesla, again, one vertical that they play in. So if I was just to choose one, I'd want the one with the broadest reach in their hands in as many cookie jars as possible. And that right now is Amazon. Next one coming in. Been a fan of your channel since this year. Appreciate it. Have enjoyed and learned a lot from your analysis. Would love to hear your one about newly listed PLTR if possible. Huge thanks and big hugs. Thank you, and big hugs right back at you. So this one, again, is recently IPO'd. I think it's Planeteer. I guess I'm pronouncing that correctly. Technologies, ticker symbol PLTR. We've got, $31 billion market cap on this one. It is relatively well followed here on Seeking Alpha, so people are aware of this one. So what I'm going to do is just really quickly take a look at just the financials. We'll take a look, just revenue, profit, see how they're doing there. With these recently IPO'd companies, I usually just assume that the balance sheet's pretty nice, and it will become cleaner because they probably will have follow-in offerings, raise some more money, and then we'll jump over the stock chart. We're actually getting to an interesting level with this one, so we'll talk about that. But let's jump into here. We got 3 months into 1920, 9 months here, and revenue's growing nicely. Okay, it's not like unbelievable growth, but it's nice. Okay, especially if this is sustainable. If they're projecting this out 12 months, 24 months out, this would be solid. Okay, you went from 190 up to 290. Okay, so that's really solid. I mean, you're bolting on like 100 million there, so that's really nice. Gross profit grew nicely as well, so the cost of revenue is well within intact as well, although it looks like margins might have compressed just slightly. 9 months as well, we went from 350-ish to about 489. Really strong growth. Okay, but you do have to keep in mind this is a $30 billion company, and so this is $31 billion. Wow. And so and they basically did 500 million. Looks like they'll do about $1 billion to the top line. So you have a pretty strong PE ratio on the sales. My guess is because the investors are projecting that this growth and the market share will continue to grow into the future. You just want to double check that if you're an investor. We've got other costs here, lots of other costs. Wow, these are major. Okay, Okay, take a look. We spent $987 on our other operating costs, and holy moly, again, we didn't even do $987 in revenue for 9 months, and we spent $987 in a quarter just on operating expenses. Whoa, that leads to a massive loss from operations at about $850 million, way over the $145 we lost in the previous period. We'll jump down to cash flows. We'll see how much this is stock-based compensation. That is potentially what's going on there. And then we lost $428 previous 9 months, all the way up to $1 billion. So obviously the net income is just going to be totally trashed on a stock like this when you're losing that kind of money. Now, from the asset side, everything looks strong. They've got cash. They don't got a ton of stuff going. Take a look. Total liabilities 1.3, and you've got 2.6 in total assets. You've got 2.4 of it tied up into current assets. You basically have we'll call it 1.85 on the cash side, and they have way more than that than just liabilities. So from a balance sheet perspective, this is as crystal clean as it gets, and that's typically what you see. Now, here's what you want to see, and this is what investors might see, because, a younger investor or investor that's not really, take a look at the stock chart. I know this is kind of little, but I'll do it maybe on a 1 year. It's a little bit better. This stock has gone from about $9 all the way up to $19, close to $20 per share. And you might wonder why, because I just ran through the financials. Quite frankly, these operating results is a complete disaster. But not always the full story, especially with younger IPO companies. Take a look at stock-based compensation. $1 billion. Okay, so yes, we had a $1 billion loss. So we pull down our net loss. We come down up here to net income. We basically netted out for 9 months here. So here's our 9 months. We lost for 9 months. We lost this $1.18 billion. So what you do is you copy and paste this number. You bring it down here to cash flows, and you paste it right here at the top, the 1.18. So that's our net loss. But that's not all cash. Take a look at stock-based compensation right here is at $1 billion. So again, like I always say on this channel, you got to pay your employees somehow. Whether you pay them in cash, you pay them in Bitcoin, or you pay them in stock, you got to pick one, okay? And they're picking to pay their employees primarily with stock-based compensation, or they're rewarding their employees with stock-based compensation. Again, not something I'm against, and it completely changes what we saw here on the operating side. Because take a look, for 9 months, we lost $500 million, but when you factor in this massive amount of stock-based compensation, which might not reoccur, I expect it to reoccur. I don't necessarily expect them to give away $1 billion of shares every 9 months. I would expect this number to come down. Typically, when you recently IPO, you might have a big reward or a big, incentive package kind of baked in there. And so a lot of it gets realized here. And this is what very sophisticated investors are probably looking at, or ones that dig into the numbers a little bit further than the average investor. And so you come down here, net cash used in operating activities, $278. That's not bad at all. And when you take into account, we got $1.8 billion, $1.85 billion sitting on that balance sheet. We're probably going to have some following offerings. We don't have any, doesn't look like we have any debt or anything really bad down here. Oh, a little bit of debt here, actually. Just some really small amount, about $200 million. That's not that much. So everything looking pretty darn good to me. Okay, they probably could tap the debt markets. They probably could tap the equity markets. So they are likely going to continue to lose money, quote unquote, lose money. But keep in mind, a lot of these expenses, especially in the most recent quarter, was stock-based compensation. In fact, about $1 billion of it. So moving over the stock chart, it looks like the stock is dancing around here. And so you've got some support here right at, we'll call it between 17.70 and 18. To make it even, we'll just push this line up to $18. So that actually is probably a pretty good trend line. So we're sitting right at it. We're at 18.25. We're sitting right at a support level. So the stock's either going to kind of dance right here at this upper level and kind of resume its uptrend, or more excitingly, in my opinion, is if it were to trend back down here. Down here, I've got it marked out really low here at 16 because we had this kind of gap and just quick candles up. This is a 30-minute time frame because with these IPO companies, you kind of have to come in here and look at them at a little bit tighter time frame. But actually, if this stock pulls back into this $16 range, in my opinion, it's definitely, and not definitely a buy, but if you're interested in this stock, interested in the sector, you believe in the company, down here at 16 would be a spot where I'd be really excited. Up here, I'd be a little more cautious, because if we do break trend up here at 18, it's probably coming back down into this box down here. And so I know it's kind of a wide box, 16 to 18, but somewhere in that range is where I would anticipate this one. But this one's probably going to make a move here pretty soon. Okay, it's either going to dance up here at 17 and kind of consolidate up there, or it's going to break down, or it's going to pop up. Okay, I can't tell you which way it's going to go, but I would tell you, comes down here into the 16 would be a spot where I would definitely be interested in that one. Next one's coming in from Patrick Parkerson. When you're trading, buying and selling stocks, do you have an LLC and S Corp to reduce the amount of you pay in taxes? Okay, so I got to be careful about giving tax advice, since I can only speak for myself. I only do my own taxes. I run all my business. I have several businesses that I run, and I've talked about here on the channel. In fact, the next question kind of relates to that a little bit. I run them all through my personal taxes. I do have an LLC set up. That is not necessarily for tax purposes, more for liability purposes. At some point, maybe I get an S Corp. There probably is some tax advantages to that. But for right now, at least from the advice that I've been given, I'm lucky enough to know somebody that actually works for the IRS, and I bounce ideas off of her every once in a while when I have questions. And so just for me personally, I've gotten some pretty good tax advice. Now, in terms of stocks, I actually don't know. I don't know if anybody does. Okay, if you have a business where you're a money manager, or you're actually running a business where you're buying and selling stocks, maybe some of this other stuff makes sense. But from an individual perspective, what I do is I do the vast majority of my buying of stocks. I don't sell a lot of stocks, but if I do, it's likely inside an IRA account, which is either tax deferred or tax free, depending on how you're setting that up. So I don't worry too much about the taxes when I'm buying and selling stocks. You can always offset that by selling some losers. Everybody has stocks that go down. If you have some major winners, you can offset that a little bit. I simply just factor that in. So I don't do a lot of trading. I don't do a lot of buying and selling stocks. The taxes I pay in my stock accounts is very inconsequential compared to the other taxes I have to pay for my businesses and things like that. But maybe going forward, it's something that I will have to pay more attention to, but I would just factor that in. Okay. Figure out what taxes you have to pay from the personal income side and from the federal side and the capital gain side, and just factor that in. But it's also another reason why I don't sell a lot of stock, because I don't want to pay the taxes. So just build wealth for the long term and cross my fingers and hope that in 30 or 40 years, when I'm going to need the money, that we haven't raised taxes through the roof, which is certainly possible, which could lead me down another tangent why I invest my money in a lot of other things other than taxes, because there are other things other than stocks. Okay, stocks is just one way to build wealth. I think it's a fantastic way to build wealth. It's certainly a key part of building wealth, but here in the United States, it is very, very easy for the United States government to know exactly how much stock you have, know when you buy it and when you sell it. And so, I'm not giving tax advice here, not trying to tell you how to avoid taxes or even encouraging that, but I'm just saying that stocks are very easily taxed. And when the government wants to put their hand in that cookie jar, it is a very easy thing for them to do. Just something you want to keep in mind as you grow your wealth in the stock market. Last question comes from Sean. What was your business during the financial crisis? So I was in college, and I was tail end of my college career, had a couple classes. I was taking maybe one or two classes towards the end. I opened up a retail store that dealt with sports memorabilia, sports products, sports trading cards, sports clothing. It was like a mini maybe like a mini Dick's Sporting Goods, but without the sporting goods, okay, without the hockey sticks and the baseball bats. I was more apparel and collectibles is what I sold. And quite frankly, it was a very good business for about a year. I opened in 2006. I absolutely crushed it my first year. I thought I was going to be high rolling all the way to Las Vegas and back whenever I wanted to. But unfortunately, the financial crisis hit and it decimated that business. But the thing that I learned, and the thing that anybody out there can learn, is that was one of the best things that's ever happened to me. Okay, actually learning that business and failing in that business brought me into other businesses that are extraordinarily more profitable and take extraordinarily less effort, okay? Because my business required me to be there and open, and while I had a partner and I only had to work half a day, I still had to be there quite a bit, okay? You had to physically be there to make money. And after the financial crisis hit, I said, hey, I want more passive income. And I started developing a lot of passive income sources and things like that. And that takes me to where I'm at today, to where I have plenty of time to record YouTube videos. While they do pay me a little bit from Google, I do have 2 children. And I have a house and an expensive car and an expensive lifestyle at times. So I have to pay for those things. And luckily, I have found some other ways to make money. But, my last advice to anybody out there watching is don't be scared to get into any kind of business, whether it's a retail business, whether it's any kind of business, because even if you failure sometimes might actually be the best outcome for you, is because that failure will teach you so many things and get you into an even more important, more profitable, and more successful business in the future. So don't be scared of failure. In fact, actually be looking forward to it and looking forward. That's probably what I learned the most during the financial crisis, is actually look forward to disappointment, to failure, to not succeeding, because oftentimes that means success is right around the corner. So hopefully I helped answer all your questions on today's show. Again, leave me a comment down below and I'll be happy to get to your question on next week's video. Thanks for tuning in. Good luck with your investments.